Okay, everyone, Jim's here now. Those of you that stuck around through this live broadcast of interview abortion. So, yeah, anyway, Jim, it's great to have you now. And I've been telling people that,
Coach,
yeah,
is everything okay? Sorry, I just made it back because I had some bug. Everything okay?
yes, everything's okay now.
Okay. Sorry, but something bugged with my computer, obviously, before I couldn't hear you.
That's okay. Okay, so Jim's here.
Yes.
Thank you, Steve, for trying. It's all Jim Welsh's fault. Don't worry about it. Okay, yes, so Jim, you know, I was telling people, besides you and me being pretty low tech, that
Can we prove that point?
that you are very unusual, because I remember the Financial Commentator was really based upon following the Fed, and you know, I read your fundamentals, and sometimes I have a hard time wrapping my head around it, but your fundamental research is good, and most people that are very good fundamental guys really aren't great tacticians. They give you ideas, but you have that blend of technical and fundamentals. So we're looking forward to what you have to say today, buddy.
All right. Well, thank you very much, Dale. Appreciate it. I am Irish, so as you all witnessed this morning, Murphy was working a little overtime. But, thank you for your patience.
Well, we're good for next time. You know, you could use your laptop.
Now I'm ready to go. All right. Okay, as Dale just mentioned, I try to combine fundamental and technical analysis. I have found over many, many years that when the fundamentals start to indicate, you know, a change in, let's say, economic trends, and then looking at technical analysis and seeing things like the advanced decline line and other indicators confirming that, gee, things are starting to weaken internally in the market. And on the fundamental side, it looks like the economy is going to be under pressure. You know, it just adds more conviction to analyzing and anticipating what may or may not be coming. So just very quickly, as we've seen over the last year, as the trade war has escalated, there's been this huge bifurcation. I mean, it's really, really unusual between the manufacturing side of not just the U.S. economy, but the global economy, and the service side. And my view has been, as long as it was contained in the manufacturing side, the services, which comprise a much larger share of GDP in every economy around the world, would kind of hold us steady. But the longer this trade tiff went on, slowly but surely, we would see the weakness in manufacturing begin to spread and infect the service side. And I think the recent escalation last week by President Trump is going to accelerate that process. And from a bigger picture standpoint, back in March of last year, when tariffs were first proposed, the global economy, U.S. economy, was really in a very good shape. There was synchronized growth. Everything was in pretty much gear. So the first round of tariffs merely kind of started to mute the growth. But this additional, as this process has continued, you know, things have slowed more noticeably. And I'll use this analogy, you know, if somebody's walking towards you, to be able to reverse their course, you have to shove pretty hard. But once something starts moving in a new direction, it doesn't take as much energy to accelerate that move. And that's where I think we are in the global economy as well as in the U.S. economy. So we're going to look at really quickly here some charts showing this bifurcation between the manufacturing and service side. And you can see, main thing as I note here on the top is U.S. manufacturing is about 11% of GDP with more than 80% of services. So the U.S. has been so far really insulated from the trade war, or more insulated. Germany's 22%. Their economy has been softening much more aggressively. China's around 30%. So that's one of the reasons why we've been insulated. This bifurcation between manufacturing and services can be seen. Like in China, the spread is about 5 points. That is unusually wide, and we'll see in a second. European Union services. Hopefully you can see this. The little the light blue line is manufacturing. You can see it's down around 46, whereas the services are hanging out about 53. That's a very unusual gap. Now, looking at it on a global basis, you can see how these two lines typically track each other very closely, both in terms of direction and amplitude.
Yeah.
But this chart is showing the percentage of about 30 different countries whose PMI is below 50. And that's the blue line. And you can see it's up near 70%, whereas the services is near 0%. That's extraordinary.
That doesn't show up anywhere on your chart, this setup prior.
No. That's
unusual, man.
This goes back to 1990, so it's a pretty good history of the last, couple of recessions in the U.S. and so forth. So the point here is, one or two things: is services going to stay strong, or are we going to see some bleed through? And I believe that's what's going to happen: is that we're going to see services start to slow. And in the U.S. In July, the services went from, I think, 55.7 to 53.7, something like that. In other words, so we're already starting to see the slowdown start to affect services in the U.S. And the ISM manufacturing for the U.S., I think, was 51.2. So we're still above 50. My guess is over the next few months, we will see the ISM for U.S. drop below 50. In terms of consumer spending, when the first estimate of second quarter GDP came out, GDP dropped to 2.1 from 3.1. A lot of that was due to trade, inventory building, but what really saved the day was consumer spending. So when you look at this bar chart of consumer spending, and this goes back to 2009, I believe, it's quarterly. Every time you see these big spikes in the last few years, they're followed by a pullback. This makes sense. Consumers go out and they buy a refrigerator or a car, they buy something big ticket, do a little, maybe they go on a vacation, and then the next quarter they pull back a little bit and pay down their bills. And what we saw in the second quarter is consumer spending was up over 4%, a very, very high number. So even if none of this trade stuff was going on.
Yeah, Jim, even I spent some money last quarter.
Well, congratulations.
All right. Anyway, I just want to let you. That's an unusual event. So go ahead.
So, this Dale, I can look. If I look at that bar, I can see.
Yeah, I bought a car. I mean, that's consumer spending, right?
That's a big item.
All right. Now I won't have any money for Christmas. Will the rest of America?
Well, it will, but I think there's a natural tendency, for spending to pull back in the third quarter, irrespective of the trade stuff. I think the trade stuff amps it up a little bit, and we're likely to see a more pronounced slowing. Now, when the employment report was released last Friday, and all this week when I listened to CNBC, people who are and still remain pretty constructive about the U.S. economy, one of the things they reference is, the U.S. jobs report was very good, 164,000. Unemployment rate is still a 50-year low. Wage growth up to 3.2%. And the U6, which is the underutilized part of the labor market, is at a 20-year low. So on the headline basis, everything looks pretty good. I like to try, when possible, to look under the surface. And again, if you were running a business, a small business, and you got 50 employees, and things start to slow down, what happens? What is the natural progression? Well, if you've got a group of employees working overtime, guess what? The overtime goes bye-bye. If you don't, that's a lot of times that's like manufacturing will have overtime. In the service sector, people are working maybe 37 hours a week. All of a sudden, you're going to work 36 hours a week. So these are the kind of forward-looking things as opposed to looking at jobless claims in the unemployment rate, because jobless claims don't move up until people get laid off, and then eventually it shows up in the employment rate. So to me, by looking at some forward-looking indicators that are ahead of that is pretty helpful. So let's look at U.S. job growth and overtime hours, and what we can see, and the dark blue line is the employment rate. So you can see it's held pretty steady. But look at the drop in overtime hours. And if you look back, this goes back again to 1990, we can see that prior to recessions, overtime hours began to drop. Annual market labor changes. This one kind of encapsulates what I'm talking about. At the top, light blue is hourly wages. So you can see it's still up about 3.2%. So the scale on the left is all percentages. Non-farm payrolls, that's up around 1.5%. And it's starting to get down near where it was in late 2017. But as we can see, it's one of the lower readings we've seen. And what this is how many jobs are being created as a percent of the total labor force that's out there. And then finally, total hours worked. And this is where it gets to the point I'm talking about, is wage might be going up from 3.1 to 3.2, hip, hip, hooray. But if you're working fewer hours, what's happening to your paycheck? It's shrinking. And so to me, what these charts imply is that we're likely to see in the next few months, job growth is going to slow. And I think we're going to start to see the same factors that have been at play are going to accelerate a little bit more. So the point is, in the next few months, I think we're going to see progressively economists lower GDP estimates for the remainder of 2019, 2020. We're likely to see earnings estimates start to be ratcheted down. And the stock market's already at a pretty expensive level historically. So the Buffett indicator, which is Warren Buffett thing, is percent of GDP of all stocks. It's at like 145%. It's the second highest in history. So
when was the first? 2000?
I'm sorry?
When was the first? The highest? 2000?
Yeah. 2000. But we're higher than we were in 2007, higher than in 73, 66, and so forth. So the market's expensive. And if you start to get a compression in earnings, I think that's one of the problems that the market faces. Big portfolio managers, mutual fund managers, this all happened a week ago. Think about it. The Fed cut interest rates a week ago, Wednesday, and Trump did his tweet last Thursday. A lot of portfolio managers haven't had the opportunity to really adjust their portfolios. And part of it is some of them are still bullish. They're looking at things like the employment report. If things weaken as I anticipate, they will start to make changes, which means maybe they'll lower their equity exposure by 2 or 3%. In that world, that's a big deal. And it represents tens of billions of dollars.
Jim, before you go to the next chart, can I ask you something? With the Fed doing what it did and that big recovery the day after Powell, I think, people are saying fumbled the ball. That's why the market sold off and we rallied 78.6 back before the Trump tweet on trade. I've heard people say that it won't matter if the Fed cuts because it can't touch the economic repercussions of a trade war escalating. What do you think?
I would agree with that. If you think about it, historically, slowdowns happen for two reasons. Either the Federal Reserve has raised interest rates, so the cost of money, all of a sudden people can't afford to borrow to buy a house or car and so forth. So if the Fed lowers interest rates in that regard, it can really, really help. Conversely, if money's been tight, and money is obviously not tight, and interest rates are obviously not high. So this trade stuff is outside, if you will, the direct connection between monetary policy and the economy. So I would agree with that. But at the same time, equity investors like to believe, that, gosh, if the Fed's cutting rates and other central banks are cutting rates, that's really good for the market. Yes, it is. But at the same time, if the economy really starts to show more signs of slowing, I think that'll kind of, in the short run, be more important. And I think the point you just raised, Dale, is if people start to realize and understand that, yes, the Fed can cut rates, but this trade stuff is kind of outside the impact zone of monetary policy, then they will come around to that point of view. I'm not sure a lot of people have totally embraced that idea.
Okay, buddy. Thank you.
All right, good question. Thank you. All right, so S&P. This is a chart I've been looking at and showing for the last month or so in terms of the S&P. It's basically a megaphone pattern. So off to the left is the 3, which is January of 2018, the high. So what does that relate to, that 3? Well, from March of 2009, I think the S&P is still in a major bull market. Wave 1 up was in early 2011. Wave 2 was the sharp break in the fall of 2011 due to the European debt crisis starting to bubble over. Wave 3 ended in January of 2018. The RSI weekly got to the highest level, I believe, in history. But since then, we've seen a huge triangle, effectively. And so what this indicated to me was that as the S&P got over 3,000, that it was nearing the end of the move up from last December. And what this implies is a decline all the way back down to the lows of last December, and probably taking them out by a small amount over the next few months. So that's the bigger picture. Now you got to take it one step at a time. You can see a couple of areas of important support. The low in June and in March 7th of this year, March 7th of this year was about 2730. I think the S&P is going to, at least at a minimum, test that level on any kind of a pullback. And then the other major area of support is 2650. So if we look off to the left a little bit, we're just below after the S&P peaked in wave B. You can see a very sharp break in mid-October, then a bounce, and then another leg down. And I think what we're seeing is we saw the initial decline, bottom early this week. The 618 retracement, I think, is 28
yesterday,
29.49 potentially. So we've recovered most of it, but I think we're setting up for another leg lower sometime, maybe starting early next week. But the bottom line is, I think the fundamental picture is going to deteriorate, and that is going to lead to some additional selling. And the market was oversold, there's rebound. Next week is options expiration, so there's potential that some of the stuff that goes on with options, with the VIX and everything else, could hold the market up. It could actually push a little bit higher. But I think the trend is more likely to be down over the next 1 to 2 months, with the potential that we'll see a drop down to 2350. If this all transpires in the big picture, the next thing to follow will be wave 5 from the March 2009 low. It will take the S&P way above 3,000, 3,500, maybe close to 4,000. So there's a huge move coming after this. What would cause that? Well, I think the Fed not only will cut interest rates, but I think quantitative easing is going to happen at some point in time, whether it's the next 6 months, a year. But we're going to see quantitative easing come into play, because the Fed doesn't have the traditional monetary tools to get things going. So basically, initially I went 25% short at about just when the Dow got, or the S&P got to 3,000, increased it to 40% yesterday when the S&P got above 2930, and we'll see. If it goes up a little bit higher in the next few days, I will probably add to that position in anticipation of a leg lower. Okay, the U.S. dollar. You can see, as you guys probably know better than I do, just how choppy the currency market has been since last November. Very difficult to come up with a pattern analysis that really fits into this thing. But you can see, okay, it tagged an upper trend line. Going back, Dale, you talked about Powell fumbling the message. Personally, I'm not in that camp. And I wrote this before that Fed meeting, that there was a group of probably 4, maybe 5 FOMC members. The 2 prominent voting members were Rosengren, Austin, and George. That their view was, hey, the economy's still doing pretty good. We didn't need to do this. I think the Fed got themselves boxed in a corner. They had to almost do it. But I thought that those 2 people would want the Fed to kind of convey a message that the next, September isn't going to be an automatic rate cut. So to me, I thought Powell delivered exactly on what the expectations were. I thought the dollar would spike up to that trend line and then head south. So it's very, very choppy. Could it make another move up there? Yes, it could. But longer term, I believe the dollar index at a minimum will go back to 95 with an outside chance down to 94 over the next 6 months. What will cause it? Counterintuitive. The Fed is going to lower rates. That's supposed to make the dollar go down because, the Fed's lowering rates. That doesn't always work. Conversely, the Fed's supposed to raise rates. That makes the dollar go up. Well, in 2017 and the first part of 2018, the Fed raised rates 4 times. What did the dollar index do? It went from 103.80 to under 89. So this idea that interest rates are the controlling factor of currencies, it's a coin toss. It really doesn't work that often, or as much as certainly people believe. I think one of the main drivers of why the dollar is going to weaken is the U.S. economy has been stronger than just about everybody else, holding up better. Why? Well, because manufacturing is a much smaller percentage than a lot of other places. But if I'm right and the economy shows more signs of slowing, especially if the tariff war escalates some more, I think the dollar is going to weaken due to economic slowing in the U.S. So technically, I think the dollar ultimately, as I said, 95 with a shot at 94 over the next 3 to 6 months. Okay, 10-year Treasury yields. One thing I'll note, if you don't follow the Commitment of Traders report that comes out every Friday afternoon, you're really missing out, I think, on a very important piece of information. Contrary, people say markets are a discounting mechanism. I hear it almost every day on CNBC, all right? And the reality is that's just baloney. If you think about it, and I'm trying to be polite here. If Dale and I were having a conversation on the phone, he knows I would not use the word baloney.
It would still start with B.
Yes, it would. Very good. Yeah. Not that there's anything wrong with baloney. Anyway, so the point being is, think about it. When the market was topping in 2007, it made an all-time high in October of 2007. What was the S&P telling us then? That everything was fine with the market? No, we went into a financial crisis. March of 2009, when it looked like the world was coming to an end, what was it telling us? That, it's time to get the money under the mattress? No. So my point is, and I can look at gold in September 2011, 1920. Oh my God, hyperinflation is right around the corner. It didn't happen. So my point is, markets are always wrong at tops and bottoms. Always, because you get so many people leaning in one direction and they've already positioned themselves. So if the fundamentals start to turn against that positioning, what happens? They begin to be sellers if they're long or buyers if they're short. And so last fall, if you looked at the Commitment of Traders report, there was the largest short position in the 10-year Treasury bond futures in history. It was like 800,000 contracts. It was unbelievable. That implied, in my opinion, that yields were going to come down. The amazing thing is, as yields have come down, the short position, normally, the guys that are large specs and hedge fund, they're trend followers. They're glorified trend followers. Normally, when the market goes against them, they adjust their position. The amazing thing is, since March, the short position went from 160-some thousand to, I think, 380,000 as of about a week ago. So these guys have been getting crushed. So if you're wondering how Treasury yields fell as much as they did from 207 last Wednesday morning to yesterday, was it yesterday or the day before? So much is happening every day. 160, a lot of it, these guys got carried out. So I'm anxious to see what the numbers show this afternoon in terms of the positioning in the Treasury bonds, because I think sentiment is already really bullish, but I think you really need to see the positioning. And if I'm right about the U.S. equity market making a trip down to 2350, it's hard to see how bond yields are going to go up in that kind of environment. But once that is over, and if I'm right and the Fed starts to cut rates more aggressively, and I think there's the potential for an intra-market or intra-meeting ease. So everyone knows the Fed's going to cut rates in September. And then now in October. I think somewhere along the way, if the market drops to those levels, financial conditions will have tightened enough that the Fed will feel compelled to ease. Just like last December and January, financial conditions tightened significantly, and they basically went on stop. So I think there's a good shortcoming in the treasuries. I just don't think we're there yet. My guess is there's a bounce, and then yields are going to come down again and at least test the spike lows that we saw this week. But again, I want to see the positioning. I want to see that the 10-year, the short position, the 10-year has really, really been whittled down.
I may just add that I was talking to Jim before this recent big drop in yields, and he was talking about this, and he said there's just too many shorts left in the 10-year, and that's when the 10-year really accelerated down from 2 to 160.
Yeah, yeah. No, I'll be honest. Did I think it was getting to 160? No, I thought it was going to at least get to 170, 174.
Right,
That was the 786 retracement.
right.
From 132 to 325 is
Yeah.
174.
Rubber bands always stretch further than we can imagine.
Yeah. Well, and if you're getting margin calls,
Right.
you are the rubber band.
I've had a couple.
Yeah. Hey, if you've been in markets long enough
Right.
and you haven't totally gone through the learning curve. Okay. Gold. Again, positioning. Last fall, when gold was trading under 1,200 bucks, the commercials had a long position for the first time in like 20 years. So the position, and large specs and the managed money, they were short. So this positioning is really helpful. It's just another piece of information at turning points. Sentiment on gold last fall was 10% bulls. Now it's 95%.
I remember when that position was grinding you, Jim, and
Yep.
really wish I would have had a video camera on when we went to 1160 in Asia
Yeah,
that day.
yeah.
How was that afternoon for you?
That was a sphincter moment.
Good one, bro. All right.
So anyway, my point is positioning is part of contrary opinion. Contrary opinion is one of the most important investment tools that anybody can have. And the reason why it's so important is it's really, really hard. It's always more fun and easier to go with the crowd. And when you get to extremes, basically everyone's negative, everyone's positive, everybody knows all the reasons. Going against the crowd is like the most stupid thing on the world. But it's the best thing. But you have to look at technicals. You have to have some fundamental reasons why you think the story's going to change, and you got to see positioning. So to me, last fall, my point was I felt gold was going to rally to 1480. That was the 50% retracement from 1920 in September of 2011 down to the 1050 level, call it, in late December of 2015. The 618 is up around 1588. I don't think we're going to get there on this move. My guess is there's a pullback coming, and that we'll see that move up to 1588 and potentially higher maybe later this year or early next year. But I think right now in the short run, things are overdone. The commercials have a bigger short position now than they did in January 2018 when gold topped out around 1360. And as I mentioned, sentiment is about 95% bulls. So I think there's another maybe pop left in gold. This long IAU sold half of the position yesterday. And I think if there's another spike above the high we saw a couple of days ago, it's time to sell into that strength. I wouldn't go short here. This has been a freight train. But I do think if you're long, it's time to, and definitely it's not the place to chase. You listen to TV and everybody and their brother is talking about gold. It's been a great place to be, blah, blah, blah. That's right. Been as in past tense. So this is another market where I think we're reaching a sentiment extreme, just like the bonds. But, I don't think the pieces are in place. And again, if I'm right about the fundamental picture that it's going to deteriorate, the equity market's going to have another potentially fairly meaningful leg lower over the next between now and let's say beginning of October. Those are going to be somewhat supportive, certainly of bonds and potentially the gold market as well. If we get a drop to 2350, financial conditions will be tightening. There will be margin calls, and sometimes crazy things like gold gets hit, not because there's anything wrong with gold. It's because I sell what I got to sell to meet a margin call. So I think there's the potential of a little bit of a liquidity event if this scenario plays out. So that's it.
You think about 1380 would be that was a breakout.
Yeah, 1400. Yeah, going back, that's wave 4 of lesser degree, all that happy stuff. So that would be my guess. Yes.
Great presentation, bro.
Hey, thank you so much, Dale. And again, thank you for having me on. Appreciate it very much. And thank to all the listeners.
Yeah, how do people get your letter?
Send me an email, Jim Welsh, WELSH, macro @gmail.com.
You have a slide on that?
I'm sorry?
Do you have a slide with your information?
I didn't do that this time, Dale.
You want to show the website you're using?
macrotides.com. But the easiest and most direct way is jimwelshmacro@gmail.com.
Okay.
Yeah.
All right,
So
buddy.
I appreciate it.
Yeah,
Thank you so much.
yeah. You know, once we got past the getting connected, Jim. Thanks so much.
All
You
right.
know, we'll get back together, and now we know. Just go with the laptop. You came in. You know, it's not a headset, but the volume was very clear,
Oh,
crisp.
good.
That's good.
Good.
And your message as well.
All right.
Very crisp, and you know, people have some things to think about over the weekend and the coming weeks that you presented. And I tell you what, I encourage people to get Jim's letter so that you're in tune with these kind of things, not, you know, once every 3 or 4 months when I bring them on, but that you get it in your email box like I do every time Jim has a view.
If I can say one thing, basically, I do a monthly issue, which really focuses more on the fundamental side of the equation. And then every Monday, a weekly technical review. There's usually a page or two about fundamentals, you know, recent fundamental data points and how it fits into the bigger picture and so forth. And then the rest of the weekly technical review, as the name implies, is reviewing stocks, bonds, the dollar, gold, and occasionally some other markets, but you know, it's all the technical aspect. So, and trade recommendations as well.
Thanks for being here today, Jim. Have a great weekend. My trading warrior brother for what, 25 years or so now, Jim. So
I think it's longer than that, Dale.
30. Okay.
Like about 91, man.
Blake would probably say 120 years. He says I've been around forever. So again, some real great charts and ideas that people aren't thinking about, Jim. So have a great weekend, good hunting, and may
the force be with us.
Yeah, and you know, that these trades work out and you clean up. That's always rooting for you, Jim. All right, buddy.
You too, buddy. Bye-bye.
All right, that's it, everyone. That's our week. Hope you had a great week. You're welcome, Khalid. You're very welcome, Samsung and Tom. It will be out on video in a few hours. Baloo will get to it. And have a great weekend, everyone. Enjoy. Remember, don't just count your pips, count your blessings. And the team and I will be back to do our best for you next week as well. Adios.